Silver at $84 with China missing. The market has not seen Tuesday yet. Silver just hit $84, and nobody's talking about why. China, the world's largest buyer, is gone. Not slowing down, not pulling back, missing. And Tuesday is coming. A settlement deadline the market has not priced in, a delivery gap of over 130 million ounces, and a clock that is already ticking. The question is not whether something breaks. The question is, who is holding the bag when it does? Welcome to Financial Crisis Explained, the one place where the numbers are never dressed up and the truth is never softened. Now, before we go any further, if you have found this channel, consider yourself fortunate. Think of it like finding a good doctor after years of bad advice. You would not leave without saving the number. Subscribe. It costs nothing. But what you might miss without it could cost everything. And one more thing. Tell us in the comments right now, where in the world are you watching this from? Whether you are in London, Lagos, Lahore, or Los Angeles, we want to know who is paying attention. Now, let us get into it. Silver at $84, not $30, not $40, not even $60, $84. A number that, for most of recorded modern market history, existed only in theoretical projections, in the quiet calculations of analysts who were dismissed as alarmists, and in the private conversations of institutional traders who never said the quiet part out loud. And yet, here it is, not as a prediction, not as a headline designed to generate clicks, as a fact. The market is staring at $84 silver, and the majority of participants, retail investors, small business owners, young entrepreneurs trying to decode what is happening to the global economy, are either not watching or not understanding what they are actually looking at. This is not a price rally, this is a signal, and the difference between those two interpretations could define the next decade of financial outcomes for anyone serious enough to pay attention. To understand why $84 is not normal, one must first understand what silver actually represents in the architecture of global markets. Silver is not simply a precious metal, it is simultaneously a monetary asset and an industrial commodity, a dual identity that makes it unlike almost anything else traded on global exchanges. Gold carries monetary prestige. Copper measures industrial activity. Silver carries both burdens at once. When silver moves, something real is moving with it. Historically, the gold to silver ratio, the number of ounces of silver required to purchase 1 ounce of gold, has averaged somewhere between 40 and 60 over long economic cycles. When that ratio stretches toward 80, 90, or beyond, it has historically indicated one of two things. Either silver is catastrophically undervalued, or gold is being driven by fear that the broader market has not yet processed. At $84 silver, that ratio is compressing at a velocity that serious market analysts have not seen in a generation. That alone would be worth examining. But that is not even the most important part of this story. Beneath the price, beneath the chart patterns that retail traders are drawing on their screens, there is a structural problem building inside the COMEX, the commodity exchange, where silver futures contracts are traded and theoretically settled with physical metal. Here's what the data shows. Registered silver, the metal that has been officially warranted, verified, and made available for physical delivery against futures contracts, sat at 88.19 million ounces going into the weekend. That number did not move. No inflow. No new metal arriving to replace what has been quietly draining out of eligible inventory. The February contract is effectively finished. And what makes this moment structurally alarming is not the outflow. It is the silence where inflow should be. Eligible silver, the broader category of metal sitting in COMEX vaults but not yet cleared for immediate delivery, continued shrinking. Another 1.2 million ounces left eligible inventory in a single session. One session. And the total COMEX inventories continue seeing net outflow even as the registered figure holds artificially flat. Now consider this against the open interest data. The March silver futures contract still carries open interest of approximately 222 million ounces. Registered silver available for delivery stands at 88 million ounces. That is a gap, a structural deficit, of well over 130 million ounces between what is theoretically owed and what physically exists to settle those obligations. For any entrepreneur or business strategist in the audience who understands supply chain mathematics, that number should stop them cold. You cannot deliver what does not exist in the vault. And the roll from March to May, the process by which contract holders move their positions forward to avoid taking physical delivery, is happening at a pace that does not solve the problem. Only 15 million ounces rolled in a single day. With 4 trading days remaining before March enters final settlement, the math does not resolve. It compounds. Silver at $84 is not the story. The story is what $84 is telling anyone willing to read it carefully. And what it is saying is that somewhere between the registered vaults, the open interest figures, and a settlement deadline the market has not emotionally processed yet, something is about to give. There's a particular kind of silence that experienced traders fear more than noise, not the silence of a slow market, not the silence of a holiday weekend with thin volume, but the silence of a participant who should be there, who has always been there, and who has quietly, deliberately stopped showing up. That silence has a name right now, and that name is China. To understand the weight of China's absence from the silver market, one must first understand the scale of their presence when they are participating. China is not merely a buyer of silver. China is the gravitational center around which global silver demand has orbited for the better part of 2 decades. Their solar panel manufacturing alone consumes hundreds of millions of ounces of silver annually. Their electronics sector, their EV battery supply chain, their medical equipment manufacturing, their military-industrial complex. Every single one of these industries runs on silver at a foundational level. When China buys, the market feels it. When China stops, the market should feel that too. And yet, remarkably, most analysts watching silver's climb to $84 are attributing the move to Western demand, to inflation hedging, to geopolitical uncertainty in Europe and the Middle East. They are constructing narratives around the price movement that conveniently ignore the single most important variable sitting at the center of this picture. The largest buyer on earth has gone quiet. And nobody in the mainstream is asking the right question, not why has the price risen, but what happens to this price when China comes back? Here is where serious strategic thinking separates itself from surface-level market commentary. China's absence is not passive. It is not an accident of economic slowdown or domestic distraction. China does not absent itself from strategic commodity markets by accident. Every major withdrawal China has executed from global commodity participation, whether in rare earth elements and copper futures and agricultural commodities, has followed a recognizable pattern. They step back. They watch the market restructure around their absence. They observe which players become exposed, which supply chains grow desperate, which prices create the entry point they were waiting for, and then they return, not as a buyer responding to market conditions. As architect of the conditions they re-enter, this is not speculation. This is the documented behavioral pattern of Chinese sovereign market participation going back 30 years. Any entrepreneur or business strategist who has studied how China operates within global commodity ecosystems will recognize this structure immediately. The question that should be keeping serious analysts awake is not whether China will return to the silver market. It is what price level they have calculated as their re-entry point, and whether the Western market participants currently holding silver exposure will still be standing when that moment arrives. There is a second dimension to China's absence that goes beyond pure market mechanics. The geopolitical architecture surrounding silver right now is unlike anything the market has navigated in the modern era. Dollar weaponization, the use of the US dollar's reserve currency status as a sanctions instrument, has fundamentally altered how sovereign nations think about commodity exposure and settlement risk. China watched what happened to Russian reserves in 2022. They drew conclusions, and one of those conclusions was that physical commodity accumulation, conducted quietly, conducted through non-COMEX channels, conducted in ways that leave no visible footprint in Western market data, is now a matter of national strategic priority. This means China's absence from visible silver market participation does not necessarily mean China is absent from silver accumulation. It may mean the opposite. It may mean that the silver China is acquiring right now simply does not appear in the data that Western analysts are reading, and this is the detail that changes everything. Because if China is accumulating silver outside of Western market visibility, then the 88 million ounces sitting in COMEX registered vaults is not just structurally insufficient against March open interest, it is structurally insufficient against a buyer whose full position nobody can actually see. Silver at $84 with China visible would be remarkable. Silver at $84 with China missing is something else entirely. Tuesday has not arrived yet, and the market has no idea what Tuesday is actually carrying. Every market crisis in recorded financial history has had one thing in common. Not greed, not fraud, not even systemic failure. A deadline. A specific, unmovable, mathematically certain moment in time when the gap between what was promised and what actually exists could no longer be managed, delayed, or repackaged into something that looked acceptable. Bear Stearns had a deadline. Lehman Brothers had a deadline. And right now, inside the silver futures market, Tuesday has a deadline. Most people who watch financial markets focus on price. They watch the number move up or down on their screen and construct entire narratives around that movement. They read into candlestick patterns. They debate support and resistance levels. They argue about whether $84 is the ceiling or the floor. And while that conversation is happening on the surface, underneath it, quietly, with the cold indifference of pure mathematics, a settlement clock is running. The March silver futures contract is approaching its final delivery window. This is not a prediction. This is not an analyst's interpretation. This is a contractual reality embedded in the structure of COMEX futures trading that has existed since the exchange was established. Futures contracts have expiration dates, and when those dates arrive, positions must either roll forward to the next contract month or settle. Settlement means delivery. Delivery means physical metal. And physical metal, as the registered inventory data has already made clear, is not arriving in the volumes this moment requires. To understand why Tuesday specifically represents a pressure point that the broader market has not emotionally or structurally priced in, one must understand the precise mechanics of what is happening inside the roll process right now. Rolling a futures position is the standard practice by which contract holders, whether institutional funds, trading desks, or commercial hedgers, move their exposure from an expiring contract month into the next available month, in this case, from March into May. It is routine, it is expected, and it happens in volume during a specific window before the front month enters its final settlement phase. The problem is the pace. Only 15 million ounces rolled in a single session, with 4 trading days remaining before March enters final settlement, and 222 million ounces of open interest still outstanding against 88 million ounces of registered deliverable silver. The arithmetic does not produce a comfortable outcome. Even if rolling accelerated dramatically in the remaining sessions, the structural gap between open interest and deliverable supply does not close. It narrows, but it does not close. And in futures, market mechanics, narrowing is not the same as resolving. What cannot be rolled must be settled. What must be settled requires metal, and metal that does not exist in the vault cannot be conjured by a deadline. History offers a precise reference point for what happens when COMEX delivery stress reaches a critical threshold. In March 2020, silver-eligible inventory dropped so aggressively during pandemic-related logistics disruptions that the spread between COMEX futures prices and physical spot prices blew out to levels that broke conventional arbitrage models. Dealers could not source physical metal at the prices the futures market implied. The dislocation was temporary, but it was real, and it was measurable. In early 2021, the retail-driven silver squeeze attempt briefly exposed the same structural tension. The registered inventory at that moment was significantly higher than it is today. And yet, even then, the system showed visible strain under coordinated buying pressure. Today, registered inventory is lower, open interest is higher, the roll pace is slower. In China, the participant whose re-entry could accelerate delivery demand overnight is nowhere visible in the data. The variables are not moving in a direction that suggests Tuesday resolves quietly. There is a concept in structural engineering called load-bearing failure. It does not describe a structure that collapses all at once. It describes the moment when a single point in a system, one beam, one joint, one connection, absorbs more stress than its design tolerates, and transfers that stress to everything around it. COMEX. Silver's registered inventory is that joint right now. Tuesday is the load test, and the market has not looked up from its price charts long enough to notice that the ceiling above it is already carrying weight it was never designed to hold. The number is $84. China is missing. Tuesday is 4 trading days away, and Part 4 will reveal what the most serious players in this market are quietly doing, while everyone else is still watching the price. There's a particular moment in every major market dislocation where 2 worlds exist simultaneously. In one world, the majority of participants are still debating the price, still drawing trend lines, still waiting for confirmation from the same mainstream financial media that missed 2008, missed the 2020 liquidity crisis, and is currently missing this. In the other world, the serious players have already moved, not loudly, not with announcements, not with the kind of theatrical market commentary designed to generate attention, quietly, deliberately, with the calm precision of people who have read the same data everyone else has access to, and arrived at conclusions 3 steps ahead of the crowd. Right now, those 2 worlds are running parallel inside the silver market, and the distance between them is measured in preparation. The first thing serious institutional players understand, that retail participants and even mid-level fund managers frequently miss, is the critical distinction between trading silver and understanding silver. Trading silver means watching the price, managing entry and exit points, and extracting short-term value from volatility. It is a legitimate activity, but it operates entirely on the surface of a much deeper structure. Understanding silver means reading the COMEX inventory reports that are publicly available and updated daily. It means tracking the ratio between registered and eligible inventory not as a single data point, but as a directional trend over weeks and months. It means watching the roll pace not as background noise, but as a leading indicator of delivery stress. The institutions that move markets are not looking at $84 and asking whether it goes to $90 or pulls back to $78. They are asking a fundamentally different question. They are asking what $84 reveals about the architecture of the system underneath the price. And what it reveals is a structure under load that the visible market has not yet fully acknowledged. For the business community watching this, for the entrepreneurs and strategic decision makers who came to this channel not for trading tips, but for economic orientation, the implications extend well beyond futures contracts and delivery mechanics. Silver is not sitting at $84 in isolation. It is sitting at $84 inside a broader macroeconomic environment where dollar debasement is no longer a theoretical concern, but a documented fiscal reality, where the United States national debt is expanding at a pace that would have been considered catastrophically irresponsible by any previous generation of economic policymakers, where the BRICS economic bloc, led quietly but unmistakably by China, is actively constructing alternative settlement infrastructure designed to reduce dependence on dollar-denominated commodity markets. In this environment, silver at $84 is not the ceiling. It is potentially the last recognizable floor before the market enters territory that current pricing models were not built to navigate. Serious players understand this distinction with absolute clarity. Consider what this means practically for businesses operating inside silver-dependent supply chains. Solar panel manufacturers, electronics producers, medical equipment companies, defense contractors, EV battery supply chain operators. Every single one of these industries carries silver as a foundational input cost. And every single one of them is currently making procurement decisions against a price environment that may look entirely different 6 months from now. The companies that will navigate this transition successfully are not the ones waiting for mainstream confirmation that silver's structural situation is serious. They are the ones already restructuring their procurement strategies, already renegotiating supplier contracts, already building physical inventory buffers that insulate their operations from the price shock that delivery stress and Chinese re-entry could produce simultaneously. This is not speculation about what might happen. This is operational risk management responding to what the data is already showing. For the individual entrepreneur, for the young professional building their first serious understanding of how macro forces shape business outcomes, the lesson inside this moment is more fundamental than any specific position in silver. It is this: markets do not warn you politely before they move. They leave data, publicly available, updated daily, sitting in inventory reports and open interest figures and roll pace calculations that tell the complete story to anyone willing to read them carefully. The COMEX inventory reports are not hidden. The March open interest data is not classified. The roll pace mathematics are not proprietary. What separates the serious player from the unprepared one is never access to information. It is the discipline to read what the information is actually saying before the deadline makes the reading irrelevant. China is missing from the visible market. 130 million ounces of open interest have no physical metal to stand behind them. Tuesday is arriving with mathematical certainty. And $84 may be the last price this market sees before it sees something it has never seen before. The question is not whether you understand what is happening. The question is whether you understood it in time.